Rental income and expenses. Rental income and expenses reporting. If you rent buildings, rooms, or apartments and provide basic services such as heat and light, trash collection, etc., you normally report your rental income and expenses on Schedule E, Supplemental Income and Loss. If you have a rental where there is no personal use, simply report income and expenses. The result is income if the income is more than expenses. The result is loss if expenses are more than income. Always keep in mind that losses are limited by the at-risk limitations and the passive loss limitations. Let's talk about rental income. Advanced rent is any amount you receive before the period that it covers. Include advanced rent in your rental income in the year you receive it, regardless of the period covered or the method of accounting that you use. If your tenant pays you to cancel a lease, the amount you receive is rent. Include the payment in your rental income in the year you receive it, regardless of your method of accounting. If your tenant pays any of your expenses, those payments are rental income. Because you must include this amount in income, you can also deduct the expenses if they are deductible rental expenses. If you receive property or services as rent instead of money, include the fair market value of the property or services in your rental income. If the services are provided at an agreed upon or specified price, that price is the fair market value, unless there is evidence to the contrary. Don't include a security deposit in your income when you receive it if you plan to return it to your tenant at the end of the lease. But if you keep part or all of the security deposit during any year because your tenant doesn't live up to the terms of the lease, include the amount you keep in your income in that year. If an amount called a security deposit is to be used as a final payment of rent, it is advance rent, included in your income when you receive it. Rental expenses. If you sometimes use your rental property for personal purposes, you must divide your expenses between rental and personal use. Depreciation is a capital expense. It is the mechanism for recovering your cost in an income-producing property and must be taken over the expected life of the property. You can begin to depreciate real rental property when it is ready and available for rent. If you pay an insurance premium for more than 1 year in advance, you can't deduct the total premium in the year you pay it. For each year of coverage, you can deduct only the part of the premium payment that applies to that year. Now remember, that is only when the premiums extend beyond a year. If the premiums extend beyond, or I should say less than a year, you can in fact take that expenditure in the year that you make the payment. You can deduct mortgage interest you pay on your rental property. When you refinance a rental property for more than the previous outstanding balance, the portion of the interest allocable to loan proceeds not related to rental use generally can't be deducted as a rental expense. If you hold property for rental purposes, you may be able to deduct your ordinary and necessary expenses, including depreciation, while the property is vacant. However, you can't deduct any loss of rental income for the period the property is vacant. If you use a dwelling unit as a home and you rent it less than 15 days during the year, its primary function isn't considered to be rental, and it shouldn't be reported on Schedule E. You aren't required to report the rental income and rental expenses from this activity. The expenses, including mortgage interest, property taxes, and any qualified casualty loss, will be reported as normally allowed on Schedule A. If you have any personal use of a dwelling unit, including a vacation home, that you rent, you must divide your expenses between rental use and personal use. In general, your rental expenses will be no more than your total expenses multiplied by a fraction, the denominator of which is the total number of days the dwelling unit is used, and the numerator of which is the total of number of days actually rented at fair rental price. Only your rental expenses may be deducted on Schedule E. Some of your personal expenses may be deductible on Schedule A if you itemize your deductions. You also must determine if the dwelling unit is considered a home. The amount of rental expenses that you can deduct may be limited if the dwelling unit is considered a home. Whether a dwelling unit is considered a home depends on how many days during the year are considered to be days of personal use. There is a special rule if you use the dwelling unit as a home and you rented it for less than 15 days during the year. And we covered that on a prior slide. Rental property is considered primarily rental use if personal use is not more than 14 days or 10% of the days rented, whichever is greater. If the property has personal use but is considered to be primarily rental use, expenses need to be divided between personal and rental. However, losses are allowed, subject to the normal limitations. Let's look at an example. John used his property for 18 days during the year. In other words, that's his personal use. He rented the property for 220 days at fair rental value. Is the property considered to be primarily rental use? Well, first, the property is rented more than 15 days, so rent and expenses need to be claimed. Second, the greater of 14 days or 10% of days rented is 22 days. That is the greater of 14 days or 22 days, and of course that comes out to 22 days. Since personal use for John is only 18 days, the property is considered primarily rental use. We do divide expenses between personal and rental. However, the loss is allowed and is not exceptionally limited. However, we always have to keep in mind the at-risk limitations and the passive loss limitations. You use a dwelling as a home during the tax year if you use it for personal purposes more than the greater of 14 days or 10% of the total days it is rented to others at fair rental price. And of course, whichever is the greater. And that's the same rule that we looked at to consider whether it was primarily rental. If you had a net loss from renting the dwelling for the year and it is considered to be used as a home, your deductions for certain rental expenses are, in fact, limited. Let's look at a couple questions. Jose is renting a house to Bill for $600 a month beginning February 2018. Bill paid $1,200 on January 15th, 2018, which included 1 month's rent and 1 month's security deposit. The rent is due by the 5th of the month. The lease specifies the security deposit would also be used as the final month's rent. Bill pays the rent on the 2nd of each month. In July, Bill also paid $150 for repairs to the air conditioning, and in September he paid $80 for roof repair. These amounts were deducted from his rent. Bill was unable to pay December's rent until January of next year. How much should Jose report as rental income? Well, first, let's include the entire $1,200 paid on January 15th, both the first month's rent or 1 month's rent and the security deposit, but the security deposit is explicitly meant as the final month's rent, and therefore we include it. So the entirety of that $1,200 is included. Now, if he paid rent on the 2nd of each month, if he paid it on March, April, May, June, July, August, September, October, and November, that is 9 months at $600. That's $5,400. But we will subtract the amounts that he paid for repair because those are amounts that he did not pay directly to the landlord. So amounts paid directly to the landlord total $5,170. The amount he paid for repairs, even though it wasn't paid directly to the landlord, since it was on behalf of the landlord, that $230 is included as part of rental income. It would also happen to be an expense, but it would be income and an expense. Now, the December rent that he did not pay until January of the next year, we do not include that in income for 2018. So, the January 15th payment, which is rent and security deposit, but again, that security deposit is considered last month rent, so we include it. The rent paid directly to the landlord, $5,170 between February and the end of the year. We include that amount that he paid for repair as rental income, but we also remember that the landlord could deduct that as well. And then that December rent, which wasn't paid till January, we do not include it. So the total comes to $6,600. Another question. This year, Todd owned a waterfront vacation home. He used it from January 1st to February 28th. In other words, 59 days of personal use. The rest of the year, he rented the vacation home for $1,000 per month at fair rental price. Mortgage interest was $15,000. Repairs were $1,500. Depreciation for the entire year, for the entire rental period, was $150. What amount is carried over to next year? Well, you know what? The first thing we need to do is recall that because his personal use was more than the greater of 14 days, or 10% of the days rented, because he rented 306 days, 10% of that is about 31 days. Well, he used it for 59 days. So this is considered to be used as a home. Since it's used as a home, he can only take expenses up to the amount of his income. Well, his income is $10,000. That's 10 months at $1,000 per month, or $10,000. His fully deductible rental expenses is the mortgage interest, and that's because he can use that as an itemized deduction. He'll be able to take that in full because mortgage interest is considered to be an itemized deduction. So how much does he have available for other expenses? Well, he's got none, because this $15,000 used up all of that $10,000 of income. there is no income available to use the other expenses against. And remember, we're doing this because this property is considered to be used as a home. That's why we're not able to use all of the expenses. However, even though we can't use the expenses, we can carry over the part that's not used. So $1,500 in repairs. The rental part of that is 83.84%, which we calculated up here. 83.84% times 1,500 means we'll carry over $1,258 of repairs. And per the wording of the question, the entirety of the depreciation is $150. And we don't really have to worry about personal and rental percentage because depreciation does not apply at all to personal. So that 150 is considered entirely rental. So we're going to carry over $1,408 to the next year because we couldn't use it this year because the place was used as a home. Since it was used as a home, we are severely limited in the amount of expenses that we can claim. Only up to the amount of income, and then full stop at that point. One more question. Ted originally built a house for $360,000 on a lot that cost him $34,000, which he used as a home for many years. Before changing the property to rental use this year, he added $62,000 of permanent improvements, claimed an $8,000 casualty loss, and claimed a $500 energy credit. On the date of the change of use from personal to rental, the property had a fair market value of $342,000. Of that $342,000, $42,000 is considered for land, $300,000 for the house. What is Ted's basis for depreciation? Well, the basis for depreciation will be the lower of the adjusted basis for the building. We ignore the land for depreciation purposes. We do not depreciate land. So, adjusted basis of the building, original cost, add the improvement, subtract the casualty loss, subtract the credit, $253,500. Fair market value of the building, $300,000 on the date of the change. Take the lower of $253,500 or $300,000, and that is our basis for depreciation, $253,500. Well, students, that's the end of our lecture and our video discussing issues relative to business, rental, income, and expense. I hope that it was helpful. Thank you.